Okay, let's unpack this. Isn't Monday, January 19, 2026? And if you made the mistake of looking at your crypto portfolio this morning,
Right.
well, you are probably wishing you had added something a little stronger to your coffee.
It is a sea of red, isn't it?
Bet.
Just assets across the board. It's one of those mornings where the group chats are either completely silent or, absolute chaos.
The numbers I'm seeing are pretty staggering. We're talking something like $100 billion wiped off the total crypto market cap
That's right, and that's in less than 12 hours.
just overnight.
Just overnight, Bitcoin slipped about 2 to 3%, which sounds manageable. But then you look at everything else, Ethereum is down even more, and the high beta altcoins are getting hammered.
Okay, pause there for a second. For anyone listening who just sees, a red arrow on their app, what do we mean by high beta?
So think of beta as just a measure of volatility. If Bitcoin is the ocean tide, high beta alts are the little boats bobbing, violently on the waves. When the tide goes out even a little, those boats can crash on the rocks. They're the riskier tokens, and traders use a lot of leverage borrowed money to bet on them.
So when things drop, all that leverage gets flushed out.
Exactly. And that just makes the losses even deeper.
Got it. So the risky stuff is crashing hardest. And the trigger for all of this, it feels like we've seen this movie before.
We certainly have. The catalyst is renewed trade war rhetoric from President Trump. But here's the twist. This time, the target isn't China.
It's the European Union.
The EU, yeah. He's announced some really aggressive tariff measures, and the market reaction was just instantaneous.
So the mission for this deep dive is to figure out why. Why does a tariff on, say, French wine or German cars crash Bitcoin? Is this a fundamental shift, or is everyone just panicking? And this is where it gets really interesting. We need to talk about the first crypto presidency. Because when the president's family business is literally crypto, things get complicated fast.
It adds a layer of complexity we've never seen in economic history. We've got sources today from all over Bigot News, NASDAQ, and a fascinating research paper called The First Crypto President.
And a Brookings report on stablecoins, right?
Yep. We're going to connect all those dots.
So let's start with the panic. As you said, Bitcoin dropped immediately. But is the economic reality, is it actually that bad?
That is the first disconnect we have to highlight. If you look at the data from analysts, the actual economic exposure here is surprisingly limited.
Limited how?
The estimates suggest these proposed tariffs on the EU would only impact exports equivalent to about 1 to 1.5% of EU GDP.
Wait, 1%? That sounds statistically tiny, like a rounding error in the global economy.
In the grand scheme of things, it is manageable. It certainly doesn't justify the scale of the reaction we're seeing today. And on top of that, if you look at the broader picture, China just reported 5% GDP growth for 2025.
So they beat expectations.
They beat expectations, even with their own trade tensions. So global demand is actually pretty resilient.
So if the math doesn't add up, this is just pure sentiment, pure panic.
It's classic risk-off sentiment. Traders hear the word tariff, they have flashbacks to past trade wars, and they just hit the sell button first and ask questions later.
It's headline risk.
Pure headline risk, not a structural collapse.
So why does crypto seem to take the punch so much harder than, say, the stock market? It feels like the NASDAQ might sneeze, but crypto catches the flu.
Because crypto never sleeps. It trades 24/7.
Right.
When a headline breaks at 3:00 a.m. in New York, the stock exchange is closed. But crypto markets are wide open. They become this sort of liquidity valve for the world's anxiety.
So it's the canary in the coal mine because the coal mine is never closed.
Exactly.
Okay, so the market is twitchy. But to really understand why it's so twitchy about Trump specifically, we have to look at the last couple of years. This research paper, The First Crypto President, it describes an ecosystem that's just, frankly, it's mind-blowing.
It is unprecedented. The paper argues that during 2024 and 2025, we saw the rise of the Trump cryptocurrency ecosystem. And this isn't just, a politician giving a thumbs up to Bitcoin. It is full financial integration.
So walk us through the pieces of this ecosystem. What are we actually looking at?
Well, you've got the Trump P token, which started as a meme coin but became this massive asset. You have World Liberty Financial, a DeFi platform associated with the family.
And American Bitcoin Corp, the mining fund.
The mining firm listed on the NASDAQ, yeah. And then there's Trump Media.
The the parent company of Truth Social, they pivoted hard into crypto.
They did. They shifted to a crypto treasury strategy. They're holding, what, something like 11,500 Bitcoin on their balance sheet.
So you have a situation where the president's own companies and family ventures are effectively leveraged bets on the crypto market itself.
And the numbers are staggering. The report says at its peak, this whole ecosystem had valuations over $11 billion. And the family reportedly generated $800 million in sales income in just the first half of 2025.
So this fusion of political power and digital assets, it's a double-edged sword.
Absolutely. When the president speaks,
Right.
he's not just moving the Dow Jones anymore. He is moving his own net worth and the net worth of millions of voters who bought into this ecosystem.
Which brings us to the elephant in the room.
Mm-hmm.
The October 2025 crash. I feel like that trauma is still fresh for a lot of people. You can't talk about today without remembering that.
That is the context the market is still processing.
Mhm.
So back on October 10th, 2025, Trump announces a 100% tariff on Chinese imports on Truth Social.
A massive escalation.
Yeah.
And the market reaction was just brutal. I remember looking at my screen and thinking there had to be a glitch.
To put it mildly, Bitcoin was at an all-time high, around $126,000.
And after that announcement,
It plummeted all the way down to below 82,000. We saw $19 billion in liquidations in 24 hours.
$19 billion. That's just wealth destruction on an incredible scale. And that Trump P token you mentioned, what happened there?
The paper estimates that the token's collapse inflicted roughly $12 billion in collective losses on its holders.
Wow.
And this gets to a fascinating concept the researchers call political finance.
Political finance. What does that mean here?
It means these tokens function as, like, liquid political merchandise. People aren't buying them for cash flow or dividends or tech.
They're buying them as a bet on the president's success, a proxy for loyalty.
Exactly. So when the president makes a move that destabilizes the market, the volatility is reflexive. It just spirals.
It's like buying stock in a sports team, but the manager is also the referee.
That's a brilliant way to put it. And when the manager makes a controversial call, the sell-off is emotional and immediate.
So when traders see a tariff headline today, even one about Europe, they're not just doing math on European exports.
You nailed it. They are remembering the $19 billion wiped out in October. They're selling the memory of the last crash, not necessarily the reality of this one.
I want to dig into the mechanics of the tariff itself, though, because intuitively you hear the whole digital gold narrative, right? If the government is messing with trade and fiat currency, shouldn't people be running to Bitcoin for safety? Why is it going down?
That is the store value argument. And long term, many believe that holds true. But in the short term, tariffs work differently. First, there's the direct impact. Tariffs aren't levied on Bitcoin itself. It's fungible. Bitcoin mined in China is the same as one mined in Texas.
But you can tax the machines that mine them.
Correct. That's the hardware risk. If tariffs hit mining rigs or chips made outside the U.S., it hurts U.S. miners like American Bitcoin Core by raising their capital costs.
Okay.
But the real killer, the one driving the price down today, is the indirect economic impact.
The bad inflation.
Yes, we need to distinguish between types of inflation. Good inflation comes from high demand. Everyone has money, everyone wants to buy things.
And bad inflation is when costs go up because of taxes or supply shocks.
Exactly. Not because the economy is healthy. That leads to economic contraction. And when the economy tightens, investors dump their risk assets first.
And Wall Street still sees Bitcoin as a risk asset.
It's treated like a high-growth tech stock. When liquidity dries up, they sell what's liquid. And Bitcoin is very, very liquid.
Okay, and then there's the DXY. I keep seeing traders posting charts of the DXY today. Break that down for us.
The DXY is the U.S. dollar index. It measures the strength of the dollar against a basket of other major currencies, the euro, the yen, and so on.
And there's an inverse relationship there with Bitcoin, right?
Generally, yes. When the U.S. dollar gets strong, Bitcoin tends to get weak.
And why does a tariff make the dollar stronger? That seems counterintuitive.
Because it creates uncertainty in global trade. Investors get scared, and when they get scared, they flee to what they see as the safest asset in the world.
The U.S. dollar.
The U.S. dollar. That drives the DXY up. And a stronger dollar makes it more expensive to buy other assets, like Bitcoin, creating immediate downward pressure.
So strong tariffs,
Yeah.
strong dollar, weak Bitcoin.
In the immediate short term, that is usually the algorithm, yeah. It's a flight to traditional safety, and safety there means cash, not crypto.
But this brings up a huge debate. Is Bitcoin a safe haven or not? Because you just said it drops when things get scary. But I remember during the banking crisis a few years back, or even during COVID, it eventually went up.
It's nuanced. The research shows that Bitcoin's role really changes based on the type of crisis. During the US-China trade war back in 2018-2020, and during COVID, it did eventually act as a hedge. Same with the Russia-Ukraine war in 2022. Bitcoin and Tether both acted as safe havens.
So why not today? What makes today different?
It's the specific geography of the crisis. One of the research papers highlights a fascinating data point. Crypto has the largest co-volatility spillover effects with the euro.
Co-volatility spillover effects. Okay, that's a bit of a mouthful. What does that mean in plain English?
It basically means that crypto markets and the euro often wobble together. There's a lot of institutional money that flows between those two asset classes.
So because today's news is specifically about European tariffs, which hurts the euro, that volatility is spilling over directly into crypto.
That's the theory. It's a direct correlation. If this were a tariff on, say, South American goods, we might not see the same kind of crash.
That is fascinating. The geography matters.
It does. And you also have to distinguish between assets. Bitcoin is increasingly acting like that digital gold, but Ethereum and the altcoins behave much more like tech stocks. They need growth and optimism. They don't like fear.
Okay, we have covered the panic, the Trump ecosystem, and the mechanics, but we have to talk about this Brookings Institution report. This is the part that really blew my mind. Stablecoins and U.S. debt.
This is the twist that most people miss. We all tend to think of crypto as being outside the traditional system, a rebel currency.
Right.
But the data shows they are now deeply entangled.
So run me through the numbers. How deep does this really go?
As of mid-2025, the big stablecoin issuers, so Tether and Circle, held roughly $177.6 billion in U.S. Treasury exposure.
$177 billion. That sounds like a lot, but give me some context.
It's massive. To put that in perspective, that makes stablecoins as a group the third largest foreign buyer of U.S. Treasuries.
The third largest.
They rank just behind the Cayman Islands and Belgium. They hold more U.S. debt than the United Kingdom.
Wait, hold on. Let that sink in. A couple of crypto companies hold more U.S. government debt than the entire United Kingdom.
Correct. Tether alone held nearly $95 billion by the end of 2024. And this isn't an accident. Post-2024 election, the U.S. signed something called the Genius Act.
The Genius Act sounds very humble.
Doesn't it? It stands for Guiding and Establishing National Innovation for U.S. Stablecoins. It mandates that stablecoin issuers have to hold their reserves in cash or very short-dated T-bills, 93 days or less.
So it legally forces the crypto market into the U.S. Treasury market.
It legally binds them together. So let me get this straight for you. On one hand, you have the U.S. government via Trump's tariffs creating volatility that crashes crypto prices.
But on the other hand, the crypto industry is one of the biggest financiers of the U.S. government's short-term debt.
It is a profound irony, and it creates a systemic risk loop. Imagine if there's a run on stablecoins, like what happened to Terra USD back in 22, but on a much larger scale.
If people panic and try to cash out of Tether or Circle because the market is crashing,
then those companies have to sell their reserves to give people their dollars back.
Which means they have to sell billions of dollars of U.S. Treasuries.
Dumping them on the open market.
Which would crash the price of U.S. Treasuries.
Exactly. It could destabilize the entire traditional financial system. It is a two-way street of risk now. The U.S. needs crypto to buy its debt, and crypto needs the U.S. dollar to back its stablecoins.
That completely reframes the power dynamic. It's not just regulator versus Wild West anymore.
They're counterparties, whether they like it or not. And that's why this first crypto presidency is so unique and, frankly, so volatile.
So for the listener who's watching their screen today, trying to make sense of all the red, what's the takeaway?
First, breathe. The sell-off today is driven by headline risk and that specific correlation with the euro. The actual underlying economic damage is probably priced in already.
But the ride isn't over.
No. The volatility is structural now. Because of this whole political finance thing, we're going to see these sharp spikes and drops whenever the administration tweets. The days of crypto just following, the halving cycle or tech adoption curves they're over. It follows the news cycle now.
It's a brave new world. From magic internet money to the third largest buyer of U.S. debt in just over a decade.
And we're only just beginning to see how all this integration plays out.
So here's a thought to leave you with. If stablecoins are becoming a top holder of U.S. debt, basically helping keep the government funded, Does that give the crypto industry leverage over the U.S. government? Or, because of laws like the Genius Act, does it mean the U.S. government has effectively captured crypto?
That is the multi-trillion-dollar question. Who's the master and who's just the liquidity?
Something to think about while you watch the charts. Keep your eyes on the DXY, and we will catch you on the next deep dive.